This is my number one top stock pick, and I'll be doing a full analysis on it. So let's get into it. Taiwan Semiconductor Manufacturing Corp is the largest semiconductor manufacturing company in the world with a market share of about 61%, and its closest competitor only coming in at 14%. The world of semiconductors is split into a few different business segments. First, we have the foundries that focus predominantly only on producing the chips. And then there are the companies that designs the chips, called fabricationless or fabless for short. Some of the most notable fabless companies are AMD, Nvidia, Qualcomm, and we're also starting to see everyday tech companies like the Mag 7 start to design their own chips as well too. And then there are the companies that sit right in the middle that are vertically integrated that do both the design and the production. These are called integrated device manufacturers. Some of these include Samsung, Intel, and Texas Instruments. And then there are the companies that just essentially license out the IPs to others like ARM. And then lastly, there are the companies that makes the machines to the foundries like ASML. Now, TSM dominates the foundry side, with its competitors taking less than half the market share. Some of these competitors include Samsung, UMC, Global Foundries, and SMIC. And it's important to note these competitors because we'll also be doing a quick comparative analysis. Now, starting off with the fundamentals, TSM has extremely strong fundamentals. Consistently, year after year, they've increased their revenues with the exception of 2003. This year's revenue is expected to be prior year of about 16% increase year over year as it increased its revenue forecast due to strong AI demand, all while increasing its cash and keeping its debt pretty stagnant. But that's not the best part. Here comes the juicy part. Their profitability is amongst the best within the industry. By far, we're talking about gross, operating, and net margins being 53%, 42%, and 38%. Let's take a look at its closest competitor in market share, Samsung, where their gross margins are about 35%, which is pretty good. But once you go down one level deeper to the operating and net margins, it's 8 and 10%. This basically tells me that Samsung isn't super efficient with their expenses, and I find it interesting how their net margins are actually higher than their operating margins because 99% of the time it should be the opposite. But that's for something that I have to look into, and that's besides the point. Now, let's just focus on the operating margins. Operating margins is essentially the revenues that you bring in minus the expenses like your cost of goods, aka your raw materials, and then after your employee payrolls. This basically tells us how profitable and how efficient a company is. The higher the number, the better, obviously. Now, its closest competitors in terms of operating margins is UMC at 24%. Now we can see that nobody comes even remotely close in terms of profitability. Now, moving over onto the valuation side, the next metric I really want to focus on is return on invested capital or ROIC. And the reason why I want to focus on this metric is because the world of semiconductor manufacturing, the foundry side, is extremely capital intensive, meaning that you have to use a lot of money to build your fabrication plants, your manufacturing plants, and all of that. And so this metric basically tells us how well a company generates cash in relation to the money that it invests into itself. So in layman's terms, I want to know that the money that they are investing into themselves is seeing a return. Now, this metric of return on invested capital is sitting at 26%, which is also the highest amongst the industry as well, too. I'll put on screen about here the competitors' return on invested capital. And as you can see over here, no one comes even remotely close. Lastly, they spend about 7 to 8.5% of their revenues on research and development and 30 to 50% of their revenues on capital expenditure, aka investments into new plant and larger purchases. Now, this is a considerable amount, but this ensures that they are the market leaders and stay with the market leaders. Now, looking at its other valuation metrics, it does look a little bit expensive compared to its peers, and that's because of the huge run up that it had. Now, the PE is currently sitting at around 31 right now, and it's also the highest within its own history. But if you look at the PEG ratio, which also takes into account its growth, it does look somewhat reasonable. Now, quickly taking a look at the other metrics, such as price to sale and price to book, it definitely looks a lot more expensive. Now, this is expected as valuations become more and more expensive as they experience a huge run up, just like what we've seen with Nvidia. By all metrics, it does look overvalued despite its run up. Now, moving over onto the dividend side. Since they are so profitable, they do issue a dividend. They issue a modest 1.44 dividend deal, which is nothing to brag about. But They've been consistent ever since they started issuing a dividend back in 2003. They even increased it consecutively 6 years in a row. Now, I wouldn't buy it solely based off of dividend itself, but paired with its consistent price appreciation, I'm not complaining. One thing to note is that they do occasionally do share buybacks, and they recently completed one as well too. Share buybacks are essentially a way for the company to buy back its own shares, boosting up its share price. So they typically only do that when they have so much cash on hand, so they think that their company is overvalued and they buy it back and reward its shareholders with an increase in price value. So this has been already reflected within its share price, but I still think it has room to run despite its recent run. Moving on to the technology side, these chips are packed with transistors. And the more transistors that they have, the more compute power that they have. So the goal is to pack as much transistors as possible onto these chips. Now, the first generation of these transistors was called planar, which can support up to 20 nanometer transistors. The next generation is called FinFET, that can support 14 nanometers. And lastly, the latest technology is called Gate-All-Around, or GAA for short, that can support 2 nanometer chips. Gate-All-Around, or GAA, is the latest technology that isn't being commercially produced just yet, but TSM has announced plans that it will start production in 2025. Intel and Samsung have introduced plans to start producing it in the future, but their timeline is also uncertain as well too. All the other competitors are still stuck on FinFET, which is producing the 14 nanometer chips. So we can see a big difference between the 14 and the 2 nanometer chips. This will take significant time for them to catch up, or even have the capabilities for them to even produce the 2 nanometer chips. The R&D cost to even break into GAA will exceed $1 billion, which is a extremely large investment that these competitors might not be able to make, as opposed to TSM, where they are already investing 9% of their annual revenues into R&D. So you could already see that TSM is already way ahead of its competition. TSM has really strong relations with its customers that they're able to get insights about future roadmaps and future product launches that can justify their heavy investments, as opposed to the smaller foundries where they have to build the facilities first and wait for orders to come in that TSM cannot fulfill. And whenever TSM is making these heavy investments, it's usually technology agnostic, meaning whatever they are researching can also be applied for other customers as well too. Here's a great example. TSM was the first to start producing the 3 nanometer chips, and Apple was the first to use it as well too within their iPhone 16 and MacBooks. Later, this technology eventually made its way down to NVIDIA, AMD, and Qualcomm's CPUs and GPUs. Now, speaking of Apple, I want to talk about the industry tailwinds that is propelling this industry forward. TSM is producing all of its chips for these AI computing. We are already seeing this in ChatGPT and NVIDIA, right? And now every tech company is starting to introduce some sort of AI feature. AI takes a lot of computing power, and TSM is the only one that's able to produce it. For example, Apple just announced a partnership with ChatGPT. Well, they will be integrated into the device itself. And they're going to be taking a hybrid approach on these queries. For unsophisticated queries, they're going to be actually locally produced natively on your phone. But for more complex queries, they will be sending that to a remote cloud server. And for your phone to be able to run these queries, your phone needs to have faster and faster chips, which TSM is the only ones able to produce. And I also quickly want to mention that earlier within the year, within the CHIPS Act, they were awarded a preliminary grant of $6.6 billion grant, meaning that they do not have to pay it back. And thus, they're building plants in Arizona. In addition to that, they were also awarded $5 billion in loans. In doing so, TSM is increasing their investment in Arizona to up to $65 billion and building a third manufacturing plant, which will produce these 2 nanometer chips. Now moving on to the risk side. The semiconductor business is extremely cyclical, meaning that demand fluctuates ups and downs. So it will go through periods of shortages and oversupply. And whenever there's a shortage, they can't just raise their prices because they're locked into long-term contracts. In addition to that, they still need to maintain their strong relationships with their customers. Remember, some of these customers are like Apple, Nvidia, and AMD. So whenever there's a shortage, they can't just jack up the price. Meanwhile, they still have a high fixed cost. Which leads me into my next risk, customer concentration risk. Apple alone accounts for 25% of its annual revenues, and the top 5 clients make up more than half of its annual revenues. So you see, with one customer goes away, They're at a huge risk of losing so much money on the top line. However, I'm not too concerned at the moment because nobody else on the market as of right now has the capabilities of producing these high-end chips. So it's not like Apple can just go off to its competitor because nobody else can really produce it. However, Samsung is close to that technology right now. And then there's China from two angles. The geopolitical risk of China invading Taiwan and crippling the semiconductor market. And then there's a risk from the IP angle. Back in 2009, their competitors, SMIC, was found guilty of stealing trade secrets from TSM, which did more than $1 billion in damages. Now, of course, this was back in 2009 and 15 years has passed, but there's always a risk of more of this happening and them poaching their talent. This geopolitical risk was acknowledged by TSM and the US government, which is why the US government is pushing so hard for them to manufacture chips here in the US by offering these huge grants and incentives. If China were to ever invade Taiwan, at least they're still producing chips here in the US rather than their sole plant in Taiwan. Lastly, they do have a buy rating with an average price target of $205, the high end being $250 based off of 7 analysts. And for me, I agree. I can totally see this hitting $200 and beyond if this pace keeps up. Now, if you like this type of analysis, please do me a favor, drop a like and hit that follow button for more content like this.